Fair value gaps are one of the most commonly used ICT concepts, however they're very misunderstood by a lot of traders. So in this video we're going to simplify everything you need to know when it comes to fair value gaps in a 3-step guide, and you guys can also claim this whiteboard right here in the description below for completely free. Make sure you go ahead and do that. Let's cut straight to the chase. What is the key to fair value gaps? How do we identify and correctly use fair value gaps to not get caught up on the wrong side of the market? Also, I've made another video on different types of gaps in the market, which I'll leave links down below. But in this video, we're specifically going over every little detail on fair value gaps to give you guys the highest probability areas to trade off. So now guys, let's get straight into it. What is a fair value gap? So a fair value gap is a 3-candle formation where an expansive or big middle candle creates a gap between the wicks of the first and third candles. So as you can see in this diagram right here, in this picture right here, we have candle 1, candle number 2, and also candle number 3. So as you can see, we have a box marked out between the wick or the high of candle number 1 in this bullish example. So the high of candle number 1 does not meet the low of candle number 3. As you can see, these two wicks do not meet, creating this fair value gap, which is marked out with this box right here. And similarly for the bearish example right here, we have candle number 1, candle number 2, and candle number 3. So for this example, the low or the bottom wick of candle number 1 does not meet the high of candle number 3 or the top wick of candle number 3, creating this gap right here, which we marked out with this blue box. So what's the purpose of this gap? Well, this indicates market displacement and the potential movement towards a higher time frame zone of interest. So let's say price has reacted of, let's say, an order block in this area right here, and price has had a very instant reaction to the upside. It could be hunting, for example, a higher time frame zone of interest, which might be an opposing liquidity pool. So let's say we have an equal high or relatively equal highs. Price could overall be hunting this area right here and on its way up, creating this fair value gap right here. And this fair value gap indicates lots of bullish pressure. So if we see a fair value gap, for example, on the higher time frame, then on the lower time frame, we could expect lots of displacement to the upside when we're making those breaks of structures. So what actually happened within this candle right here? Why was there a gap within this candle? Well, we call this a buy-side imbalance, sell-side inefficiency for a bullish example. So as you can see, lots of buy orders occurred right here and not enough sell orders. And that's why we use this as a bullish PD array, which we're going to get into in a second. And for the opposing side, a bearish fair value gap. This is what we call a sell-side imbalance, so meaning lots of selling occurred here, and a buy-side inefficiency. So there wasn't enough buying in this area right here. There was loads of sell orders that the market might potentially mirror or fill once it comes into this fair value gap area again. And what do I mean by using fair value gaps for trade entries and stop losses? Well, you can use these to enter off. So let's say price retraces back into this area, we could enter at the top of the fair value gap, place our stop loss below the fair value gap, and then expect price to push much higher after reversing into this fair value gap area right here. Similarly, for the sell example, we could use this fair value gap as our entry area right here, our stop loss may be above the high, and then expect price to retrace into this area and then have a push down overall, and we can catch the sells from this area. But this is all subjective. It all depends on the overall narrative, which we're going to get into later on in the video. Just want to keep it very simple. And we also go over exactly how to utilize fair value gaps in different ICT strategies in the course. So make sure you go ahead and check that out in the description below. And here are some key points. Market displacement indicates continuation. So when price is moving to the upside impulsively with a fair value gap, it's telling us that, okay, price wants to carry on with that bullish trend. Or if price is making a bearish fair value gap right here in the correct areas, it's telling us, okay, price wants to continue with the bearish trend. Every fair value gap needs narrative for you to trade them. This is a very important point. You might have seen on the charts yourselves, if you're more advanced traders or you're more experienced in the markets, you might see a random fair value gap form. And let's say you were to randomly take a trade off this with no context behind this fair value gap, price will end up going straight through your fair value gap and stopping you out. This is because you do not have narrative behind the fair value gaps. So even though price might print a fair value gap, we're not going to be trading off random fair value gaps. There has to be narrative behind each trade, right? Behind each fair value gap, there will be narrative and a story behind it. When it comes to fair value gaps and consistency, we have one-sided gaps and we have two-sided gaps. What do I mean by this? Well, as you can see with this diagram right here, we have a normal fair value gap right here. We have candle number 1, candle number 2, and candle number 3. So when it comes to this example right here, you can see all 3 candles are green candles. They're all up close bullish candles, meaning they're all one-sided. this is a high probability fair value gap, which we can expect price to be supported from. So as you can see, once the fair value gap was created at this point right here, price retraced into this area and then continued pushing to the upside because this was a high probability gap, right? However, on the other side, we have a two-sided bearish fair value gap. So we have candle number 1, candle number 2, and candle number 3. So yes, candle number 1's low does not meet the high of candle number 3, meaning it's a valid fair value gap. However, there is inconsistency within this gap. Candle number 1 is a bearish candle. Candle number 2 is a bearish candle. However, candle number 3 is a bullish candle, meaning it's not the strongest fair value gap that there is. So when price retraced into it, price did not react bearish off this level right here. Instead, price went straight through the fair value gap, disrespecting the fair value gap. And this is an example of when fair value gaps do not work. And also just a quick one, guys, for those of you that want to level up your live trading journey, as you can see in the signals room, we're killing it. We're the best signals room in the game. We specialize in GBP, JPY signals. However, I will be sending out more trades and more daily analysis on other pairs like forex pairs, futures, and also gold. So make sure you check this out. As you can see, we smash and take profit every other day. We are on a win streak right now, so make sure you go ahead and join. I've kept it as affordable as I can for everybody, $30 a month. Also, if you want access to the funded fast EA robot, it's got a consistent, proven track record. So make sure you go ahead and click the link in the description below. Any questions you have, send us a message at fundedfast on Telegram. We are completely transparent and we've been doing this for the longest. And also, if you want your challenge passing, you can see on this group right here, we have been doing this for the longest. So any challenge that you want passing, let us know. Message fundedfast on Telegram or join this group right here and message fundedfast. Guaranteed pass, or you get 100% full money back guarantee. So now that we've covered consistency, let's get into displacement. The next point, probably one of the most important points when it comes to fair value gaps and winning trades with fair value gaps. If the market expands through a previous high or low with displacement, it indicates a continuation of the current trend. What do I mean by this? So as you can see in this example right here, we have a high and then we have a low, and we have price displacing through this high quite nicely, retracing and then pushing back to the upside. A break of structure gap is crucial for this reason, displacing through a previous high or low, or breaking the market structure, which price did with this high right here with a fair value gap. So with these three candles right here, candle number 1, candle number 2, and also candle number 3, signals a strong move and a willingness to continue the trend to the upside, because I can see quite obviously price is moving higher, displacing through this gap with our fair value gap. And you guys might have traded off this without even knowing. So let's say you find a fair value gap that's in line with a market structure point that it broke previously. That's a very high probability fair value gap, and I do want to look for trades off that level. Also, just a quick pointer on the displacement gap. Notice how we have an inconsistent two-sided fair value gap. So we have an up close candle, but a bearish close candle. However, the pros of this fair value gap was that it created displacement with this break of market structure right here. So therefore, we could still expect price to retrace into this fair value gap and still move higher, even though it was a two-sided fair value gap. As you can see, the break of structure and the displacement outweighs the consistency of the candles. So as you can see, an inverse fair value gap is identified when a fair value gap is disrespected. So this means when price closes over a lower probability fair value gap with displacement. So as you can see, we have candle number 1, candle number 2, and candle number 3 right here, right? So once price retraced into this area, we didn't see a move below. We saw price move completely to the upside. This clearly indicates a willingness to move in the opposite direction, because it literally disrespected a sell side imbalance, buy side inefficiency. So meaning a lot of buying pressure was needed to disrespect this gap right here. The strategy's probability increases when combined with other confluences, such as a sweep of liquidity before the inversion. As you can see, price moved to the upside and it created this short-term low. You can see we have a wick right here. And what did price do? Price took out this low with the fair value gap. However, it also tapped into this opposing draw on liquidity right here, which was the fair value gap. So you can see we have candle 1, candle 2, candle 3, creating the fair value gap after this move to the upside, and price also swept liquidity. Therefore, that's why this fair value gap that we saw here was likely to be disrespected after price filled in this true fair value gap right here. We did tap into it again right here, but again, look at that reaction. Look at how sensitive price was to this inverse fair value gap right here. So when you do notice a fair value gap is broken, or flipped, we can use that as an inverse fair value gap. You don't just want to delete that level instantly, because price can go ahead, return to that area right there, and then respect that in the opposing direction. So now let's go over the power of fair value gaps paired with narrative on NQ. So let's break this down. So overall on the 15-minute time frame, price has been trending to the downside overall, and the draw on liquidity was bearish. We go over exactly how to find the daily bias and draw on liquidity in the course, so make sure you go ahead and check that out. So now on NQ, you can see we've made a high and we've had a lot of displacement to the downside. But as you can see at the top of this range right here, price has left an extreme fair value gap, which is also in line with this order block right here. So therefore, when price retraces all the way back into this fair value gap area, we can expect selling off. Now, another misconception a lot of people have about fair value gaps is that price isn't allowed to disrespect them, which isn't true. So we use FVGs as a magnet for price. Now, if price taps into the fair value gap, then rejects off it instantly, that's great. However, if it fills it in and moves past the fair value gap, that's also completely fine, because remember, it's a gap and it can be filled. So anyways, you can see price filled in that gap over there. We saw this high get taken out to the upside, and then we saw a lot of displacement again to the downside, also filling in this previous fair value gap right here. So again, if you want to mark this one out, you can. And because of the overall narrative and the overall bias, price then disrespects this bullish fair value gap with this move to downside. As you can see, price breaks structure to the downside and also creates this overall inverse fair value gap. But again, that's a very big gap to be entering off. So therefore, we can refine it. We can use this fair value gap, this extreme fair value gap of this range overall. And we can use this in line, if you look to the left, with this order block right here. So as you can see, we have this last up close candle before this down move, which price pretty much just about swerved right here. As you can see, this order block right here was not filled in exactly. Let me just move this to the upside a bit. So you can see this order block was slightly swerved. However, if you would have used the fair value gap to enter off, you would have been tagged in on the trade. We also have a bit of a breaker block here, but we're not getting into that right now. So anyways, if you were to take the trade strictly based off a fair value gap, you can again use fair value gaps in multiple different ways. You can use it for your overall narrative, and you can also use it for your entry method. So let's say we were to place our entry at the bottom of this fair value gap right here and place our stop loss either above the gap or above the overall high, which you also can do, because then your stop loss is in a very safe place. You can then target opposing liquidity or opposing fair value gaps. But right now we see completely obvious equal lows. You can see we have this low right here, we have this low right here, we have this low right here. These are all relatively equal lows where liquidity is resting. So therefore we can target this overall low right here, target this low for around a 1 to 3 just off a simple fair value gap retest right there, right? And that's how you could have caught the start of this drop on NQ. Again, another example, we see a lot of displacement to the downside, and this is an example of a displacement gap being used to perfection. So as you can see, we have this low that was broken, and in line with this low, you can see we have lots of displacement, but specifically candle 1, candle 2, and candle 3. What do you notice about these 3 candles and also the previous fair value gap that we used? They were all one-sided. Another sign that it's a high probability fair value gap. Again, with this fair value gap, we have candle 1, candle 2, candle 3, all one-sided, all bearish candles. We also have price displacing below this low, so we have a displacement gap as well. And you can see it also did a turtle soup right before it tapped into that area right there. Again, if you go into the lower time frames, it will be a lot clearer. Then you can see we had that massive drop off to the downside, quite obvious liquidity pool resting below this low right here. You can see we have relatively equal lows in this area right here. And as you can see, price has been tanking literally this whole day. So whether you took profits, took partials, however you wanted to manage your trade, that's up to you. But I'm showing you guys how you can catch the entries and benefit off the overall moves and not get caught up on the wrong side of the market. Narrative plus fair value gap. You might hear me saying sometimes we have an order block plus a fair value gap. We have a low plus a fair value gap. Regardless, we want narrative plus the fair value gap. The fair value gap itself is useless if you don't know how to trade it. And also I've set you guys some homework because I want to make sure that you guys fully understand this. So find 10 examples of high probability fair value gaps that price respected. So just go on the chart, right, whatever time frame you want, and monitor the fair value gaps. If price comes down into a fair value gap, right, and rejects off it and moves in the opposite direction, so it's supported, let's say it's a bullish fair value gap and price supports that theory of that bullish fair value gap and we see a reaction, I need to zoom into the fair value gap and have a look at it. I need to monitor the consistency of the gap. So within that fair value gap, were all candles bullish? Was it all one-sided or was it two-sided? I want you to monitor whether the displacement of structure was present. So did price break structure with that fair value gap, right? Was it a displacement gap overall? I want you guys to also note down the overall narrative and the overall bias of this fair value gap. So overall, was the draw on liquidity higher or was it lower overall? So that's all. Thanks for watching, guys. I appreciate every single one of you that leave a like and comment down below. Make sure you also subscribed to see some more videos. I will be uploading a lot more consistently. I know I haven't been uploading recently for quite a while. Make sure you let me know in the comment section down below what videos you want to see next. And remember to claim your free ICT guide in the description below. You will get access to this whiteboard. And that's all for this video. I'll see you guys in the next one. Peace.